Hello and welcome back. You're watching Closing Trades here on ET Now. We're joined by Vinod Karki of ICICI Securities. Great having you here, Vinod, and thanks so much for waiting very patiently. But that was an interesting conversation which I just couldn't let go of. Vinod, I'm sure this one's also going to be equally interesting. How do you position yourself in a market which is where there's so much sector churn, so much sector rotation? You're, of course, an equity strategist. And you understand macros plus flows plus earnings, all of it together. So give us a sense as to how you're looking at the picture.
Yeah, thanks. And yeah, that was an interesting discussion I was just listening to, which you were having earlier. And some of that connects to what I'm going to say. So first of all, one thing which is happening, I mean, there's several moving parts here for the market. One, if you look at the positives, the big one is that, after a scorching couple of years of massive, bull run in the AI infrastructure stocks, finally we are seeing that fizzle out. And what was happening because of that was that India was losing favor because India was not giving those it did not have any AI play, and the growth was not looking that good relative to some of these asset classes. Now that seems to be that hot market is developing some fatigue, it seems. So from that perspective, I think, and as simultaneously what happened during this quarter is that if you look at the inflation numbers, it started to pick up. And while inflation is picking up, the productivity in the economy in terms of volume growth, we saw some of these auto companies and others, cement companies, the volume growth and the productivity in the economy has not suffered due to the West Asia crisis. So if you combine decent productivity growth in terms of volume and add to it that inflation has started to now rise, you will be getting some good double-digit nominal growth, which will again get translated into good earnings growth. So this combination of nominal growth finally picking. So what has happened in the last couple of years? One was this AI boom, and we missing the AI boom, plus our nominal growth was in single digit. And now both are turning. So that's why you are seeing some element of, the FIIs started to return to some extent, at least. At least the selling has gone, it's lesser. And we do see sporadic buying here and there. So I think that is a good thing. But we again see the resurgence of the West Asia crisis again. But to that logic, we have a longer-term view. What we just released a note yesterday talking about this, and which says that over the last decade, and starting from 2016, which was the period where the Brexit vote came in, and Trump's first tenure, which started this whole tariff thing, and then the pandemic, and then the Russia-Ukraine war, and then the Trump part two, and now the West Asia war. We are seeing an environment of elevated geopolitics, and which has these military conflicts plus the economic policies which are inward-looking. Each country for itself kind of thing. So I think. This is not going away anytime. So if we try to think in a way that let's say the West Asia war will get over and everything will be fine, something else will come up. I mean, we're already seeing some news on the tariff, which we just speaking about on pharma sector earlier. So I think this is a new world era in our view, where from the free trade era we are moving to this inward-looking policy era, where this will be an ongoing thing. It will not settle at something that something gets fixed and it's settled. Something will keep cropping up time and again. But at the same time, what you have to realize is that during this decade, the global trade to GDP is actually at an all-time high of around 68%. 2016, it was around 54%. So what it says is that the global economy finds its way around these kind of inward-looking policies, high elevated geopolitics. All that is fine, but trade finds its way around it in various ways. So we think that this environment itself gives opportunities to a different type of. So if you see from the pre-COVID time till now, the stocks which have really and sectors which have really taken off are in the capital goods sector, in defense, in manufacturing, in some of the auto companies, some of the financial services which are related to capital markets or corporate lending, PSU banks, and those kind of things. So I think this new economic environment is throwing up new winners in our view, and the market participants have to actually focus in those areas where this new era will actually throw up opportunities.
Hi, one of the arguments for flows was the growth and earnings growth for the Indian market. Given the kind of numbers we have seen, and the anticipation was that the financial services will be performing much better compared to others. We haven't seen that kind of spark coming in from the private sector so far. How do you look at the financial earnings growth in that background?
So, see, the financial services having a unique problem. I mean, if you look at the top line growth, I mean, in terms of credit growth is now almost 18%. So I don't think if you just look at it from a demand perspective of credit growth and all, I don't think there is any problem. The problem is largely to do with the NIM compression cycle. I think it's at the fag end of the whole cycle. I don't think rates are anyway. I mean, in this environment of inflation rising, going to fall further. But the NIM compression is still there to some extent. But the larger picture is that that the credit growth is quite robust. I mean, if you look at the credit growth last year, same time, it was almost at par with the nominal GDP, which was at around 9%. From 9%, it has moved to 18%. And as per the RBI's latest data point, the NPAs are at a record low, multi-decade low level. So I think the margin angle is fine and well taken. But if you were to project forward, if you are in an environment where nominal growth is going to pick up and credit growth is going to be strong, and inflation is rising, typically NIM compression cycle would be something which will not hamper growth in earnings going forward. So yeah. So and we also saw at the PAT level, in fact, most of these large banks do pretty well, despite the NII growth not being that well, because NPAs were low and provisioning was low. So at the headline Nifty level, actually, the profit growth for some of these banks was pretty healthy, almost 20% thereabouts, some of these banks. But obviously, the NII growth was not good, and the NIM compression angle was there. But from a NPA cycle or a credit growth cycle or the corporates releveraging cycle or the CAPEX cycle, I think things are looking positive overall.
How should what sectors or segments are looking interesting? Obviously, there's been a bit of a value unwind which has already happened, from the lows of March to now, right? So that re-rating seems to have happened to some extent in terms of multiples. But where will earnings growth velocity outperform what the street is currently penciling in what sector segments? Or where is it that there is still some value unwind left to kind of tactically play some of those sectors or spaces, if you can give us a sense?
So I think stocks, performance usually, chases growth wherever growth is picking up. I think clearly in this environment, which we talked about, the areas where growth is looking pretty good, be it capital goods, defense, manufacturing, in discretionary consumption, be auto, retail, and some of the other discretionary consumption areas. The growth is pretty very good, and in terms of the financial services, the banks and all we just talked about, I think that's an area where still the concern on margin is keeping a lid on the stock performance. But I think that the credit cycle is picking up along with nominal GDP growth and the CAPEX cycle. So I think that remains an area where the valuations are still quite reasonable. Commodities, I think, also should do well in this era of inward-looking policy, shortages, and all those kind of things. So that area should also do well. So if I to bucket them under three areas, I would bet on the industrials, the discretionary consumption, premiumization area, and the financial services where growth is picking up.
Vinod, interesting that you have taken discretionary spend and financial services as well. But over and above that, is there any sector which is now safe haven for investing, given the fact that almost every company or which are coming out with earnings, there is an imprint of the impact of West Asia on them, on the margins for them. Which are if you are going to look from a year or two perspective, which are the companies which would continue to do it, and it's between the asset classes like a mid cap, small cap, and the large cap, where would you look for growth?
Yeah, so if I look at from a asset class perspective, large, mid, small, clearly what we are observing is that some of the mid companies are actually giving higher growth than the large caps for sure. So, but at the same time, when I look at their valuations compared to their larger counterparts, they are not cheaper. So that valuation premium is there. So it's not a case where you will have cheaper valuations and higher growth. It's kind of setting off to some extent. So I think growth-wise in general, I feel that the small cap, mid cap space may generate higher growth. But markets are pricing in higher valuations already to some of these stocks and sectors. So yeah, so you'll have to live with that. For growth you'll have to buy it a little expensive, and wherever you finding cheap valuations, growth is a concern. So market is not leaving anything free on the table. There's no free lunch over there clearly. What I do see is that because of financial services and banks, as I said, is a situation where structurally in the economy we are seeing the credit growth pick up, but it's not kind of reflected in high valuations of high performance and high valuations of at least some of the banks. I think, but from broader macro perspective, things are looking good in terms of record low NPAs and credit growth picking up, and the NIM compression cycle at its end, and valuations not at peak. So it is leaving some room for comfort for investors to not go wrong in that area.
Vinod, it was a pleasure talking to you and getting a perspective on where we are, especially in this uncertain times. Thank you very much for joining us today.
Thank you.
Vinod.